While Tesla is up 38% over the last month, Rivian is up even more at over 40%. With production increasing, gross profit about to turn positive, and $6.6 billion from the government. Is Rivian's run just beginning, or is it time to pump the brakes on this EV superstar? Let's dive in and find out. 4 points that we are going to cover in this video. Number one, background/business model. A little over 3 years ago, Rivian was one of the most hotly anticipated IPOs in the market, but the stock has lost almost 82% since. With a focus on pickup trucks and SUVs, along with prominent backers such as Amazon and Volkswagen, Rivian is trying to become the name brand for environment-conscious adventure seekers. Part two, the opportunity, positives and negatives. While Rivian is facing the same growing pains as any early-stage growth company, its key partnerships and visionary leadership are making sure that it's here for the long haul. Part three, company updates. The company recently reported 3Q24 results with expanding production capacity and improving financial results. Other updates include a multi-billion-dollar partnership with Volkswagen, a $6.6 billion federal government loan, and a recent investor conference. I've simplified everything and focused on the key takeaways just for you. Part four, valuation. On Wall Street, we build three-statement financial models culminating in a discounted cash flow or DCF valuation. I have built a three-statement model with a DCF for Rivian, and I can't wait to give you all the details. So let's dive right in. If you're enjoying this, please smash that like button. Do you want to build wealth and have a proven system to pick winners and avoid losers?
No, that's not all. I want to be rich.
Investing success requires discipline, the skill of investment analysis, and the techniques that are proven. Some of the world's largest asset managers and investment banks pay me thousands of dollars a day to train their analysts. But what if you could have access to that knowledge for just a fraction of the cost?
Sounds good to me.
That is exactly why I created the Win Like Wall Street community, to give regular folks like you and me the tools and cutting-edge strategies to build wealth consistently and predictably. Don't wait. Right now, go to bit.ly/WLWS to join my exclusive community, Win Like Wall Street, where you can get the same Wall Street knowledge as the world's largest financial services firms, my Excel models, and direct access to me. See you on the inside. All right, part one, background/business model. Imagine you're hiking in the wilderness and you see a futuristic electric truck silently cruising over rocks, through rivers, and into the sunset.
But that's fiction. That's movies.
Nope. Meet Rivian, a company trying to make rugged, adventurous electric vehicles for people who love the outdoors and care about the planet. How did they get here, and why are they special? Let's find out. Founded in 2009 by RJ Scaringe, a car enthusiast with a dream of building sustainable vehicles, Rivian didn't rush to market. They spent over 10 years designing their cars. They launched their first vehicles in 2021. R1T is the world's first all-electric pickup truck, and the R1S, an electric SUV built for adventure. Now, the highly anticipated IPO occurred in November of 2021. The company priced 153 million shares at $78 per share, above the expected range of $72 to $74, raising almost $12 billion. The stock closed that day at over $100, giving investors a one-day gain of almost 30%. The IPO gave Rivian an initial valuation of roughly $78 billion, and at the close on the day of the IPO, the market cap was nearly $100 billion, the largest IPO of 2021 and a valuation larger than General Motors and Ford. A week later, the stock soared to an all-time high of $179.47, but it has come crashing down to earth, down almost 82%, closing under $15 yesterday. So what's the takeaway? Rivian is an EV company focused on building electric trucks, SUVs, and delivery vans for adventurers and businesses, balancing ruggedness with sustainability. Now, very important that we discuss Amazon's investment in Rivian. This is massive.
Rivian's running this like three-ring circus, right, where it has its own pickup and SUV and the Amazon van all trying to happen at the same time. Production on the pickup started modestly at the end of August and into September, and now it's kind of running at a steady rate. Sources tell us that Rivian is shifting resources, people to the Amazon van because, frankly, Amazon is one of its biggest investors.
So Amazon was an early investor in Rivian and is one of Rivian's strategic partners and largest investors with 15.5% ownership as of September 30th. In 2019, Amazon led a $700 million funding round to support Rivian's development. Amazon also signed a deal to purchase 100,000 electric delivery vans, solidifying Rivian's role in Amazon's climate pledge to achieve net zero emissions by 2040.
Tech company Amazon has released a closer look at its new electric delivery van. 100,000 vehicles have been ordered, an order worth an estimated $4 billion.
Rivian custom designed these electric delivery vehicles with Amazon's delivery operations incorporating safety features such as external cameras, efficiency, they're quiet and emission-free, and utility, they're optimized for last-mile deliveries. Now, in terms of production and deployment, Rivian started delivering these electric vans to Amazon in 2021. By the end of 2023, Rivian had delivered several thousand of these EDVs to Amazon, and the rollout is expected to accelerate over the next few years. The vans are being used in over 500 US cities for deliveries, proving Rivian's ability to produce commercial vehicles at scale. Benefits to Rivian, so they get a steady revenue stream, because the order provides Rivian with significant long-term revenue, helping the company cover production costs while it's scaling up. Credibility and exposure. They're partnering with Amazon, one of the world's largest companies, which boosts Rivian's credibility as a reliable commercial EV manufacturer. Testing and feedback. Amazon's delivery fleet gives Rivian valuable feedback on improving performance and efficiency for future vehicles. Benefits to Amazon. Sustainability goals. The EDVs help Amazon reduce its carbon footprint and meet its climate pledge commitments. Custom vehicles. Amazon benefits from vans specifically tailored to its delivery needs, optimizing performance and cost efficiency. Now, is Rivian too dependent on Amazon? While the partnership with Amazon is a huge win, some investors worry that Rivian's reliance on Amazon for commercial vehicle sales could make it vulnerable. Amazon holds exclusive rights to Rivian's electric delivery vehicles for a period of time, meaning that Rivian cannot sell these vans to other companies yet. If Amazon slows its van rollout or reduces its orders, Rivian could face a revenue gap. So what's the takeaway? Rivian's partnership with Amazon is a cornerstone of its business strategy, providing a steady revenue stream, production scale, and credibility. However, Rivian will need to diversify its commercial partnerships in the future to avoid over-reliance on Amazon. Business model. How does Rivian make money? Rivian's plan isn't just about trucks for fun. It's about trucks for work and play with big deals behind the scenes. So number one, they sell electric vehicles. The R1T truck and the R1S SUV are sold directly to customers. Prices range from $70,000 and above, targeting premium buyers. Commercial vehicles or big business orders. Amazon's order of 100,000 electric delivery vans brings long-term revenue. And Rivian's EDVs are tailored for delivery companies. Subscriptions and software. Rivian offers features like advanced driver assist systems and over-the-air updates. These add-ons mean recurring revenue for Rivian. So what's the takeaway? Rivian makes money by selling premium electric vehicles to adventure lovers, businesses like Amazon, and offering software upgrades for long-term profits. Part 2, the opportunity, positives and negatives. I'd like to hear the bad news first, so let's dive into the negatives. Imagine you're building a treehouse, but it's raining. You're low on tools, and your friends keep asking, when will it be done? Rivian's growth story has its fair share of problems. High cash burn. Rivian spends billions annually to grow production, but hasn't turned a profit yet. Competition. Ford, GM, and Tesla are launching electric trucks and SUVs, increasing pressure. Scaling challenges. Ramping up production while controlling costs is tough. Missed deadlines can hurt confidence. Stock volatility. Rivian stock has had very up and down history. Up over 40% in the last month, but down over 80% since its IPO, making it risky for investors. So Rivian faces challenges like high spending, fierce competition, and a bumpy path to profitability, which make its stock unpredictable.
We have to look on the bright side.
Here's the exciting part. Strong demand for EVs. Rivian's R1T and R1S have loyal fans, and EVs are the future. Amazon partnership. So Amazon's order for 100,000 delivery vans provides steady revenue and growth. Innovative products. Rivian focuses on adventure and lifestyle electric vehicles, something no other brand does as well. Improving production efficiency. Rivian is getting better at making cars faster and cheaper, which will help with profitability. Visionary leadership. RJ Scaringe is seen as a visionary, guiding Rivian with a clear long-term strategy. So what's the takeaway? Rivian's unique products, strong partnerships, and growth potential make it a compelling long-term story, especially if they manage their challenges. The question is, will they become the Tesla of trucks and SUVs, or will they stumble along the way? Let's check out some of the recent company updates. Production and deliveries. They produced 13,157 vehicles and delivered 10,018 vehicles in Q3 24. There was a disruption in production due to a shortage of a component in the Enduro motor system, impacting output and deliveries. Financial performance. Revenue of $874 million was down from $1.3 billion in Q3 23. Gross profit. It was negative $382 million, but it was an improvement from negative $477 million a year ago. Rivian continues to make progress in reducing costs, particularly with the launch of second-generation R1 platform. This is a critical step toward reaching positive gross margins in Q4. Adjusted EBITDA of negative $757 million, an improvement from negative $902 million a year ago. Net loss improved to minus $1.1 billion from minus $1.37 billion in Q3 23. Rivian's cash burn remains significant, with free cash flow at minus $1.15 billion in Q3. Cost reductions. Significant material cost reductions are seen in second-generation R1 vehicles, and they're on track for a 20% cost reduction in R1 vehicles by Q4 24. Strategic progress. Volkswagen partnership. So now they have a joint venture valued at over $5 billion, which validates Rivian's technology leadership and brings financial stability. I cover this in major detail next. This is going to provide financial resources to fund operations through the R2 launch. This is also going to help scale Rivian's innovative zonal network architecture and software platform. The R2 platform is key. Rivian's R2 platform, launching in 2026, represents the company's long-term growth opportunity. It aims to simplify manufacturing processes, lower material costs by 45% compared to R1, and address global markets and mass market price points. Progress on the R2 platform. 85% of the R2 components are already sourced. Outlook for 2024. They reaffirm production guidance of 47,000 to 49,000 vehicles. They have a delivery outlook of 50,500 to 52,000 vehicles, and they expect modest positive gross margin in Q4 24. So some key takeaways for investors. Rivian is making steady progress toward profitability, reducing costs and increasing production efficiency. The Volkswagen partnership significantly enhances Rivian's financial runway and validates its technology for global EV markets. Now, their short-term risks include production disruptions, cash burn, and a challenging consumer backdrop. Rivian's focus on the R2 platform and commercial partnerships like Amazon position it for long-term success. All right, so the Rivian-Volkswagen partnership announced on November 12th of 2024.
Germany's Volkswagen says it will work together with U.S. auto startup Rivian to develop software for its cars. Volkswagen is set to invest up to $5 billion into a joint venture with Rivian.
So joint venture creation. Rivian and Volkswagen Group announced a $5.8 billion joint venture named Rivian and VW Group Technology, LLC. The focus is on developing next-generation electrical architecture and software systems for electric vehicles. Strategic goals. Rivian contributes industry-leading software and hardware technology. Volkswagen Group brings global scale and manufacturing expertise, enabling affordable EVs across various price points and segments. Financial structure. So Volkswagen's total commitment is up to $5.8 billion, broken into milestones. So $1 billion convertible note, which was done in June 2024, a $1.3 billion cash payment for a 50% stake in the joint venture that occurred at the end of November of 24. There's an additional $1 billion equity investment in 2025 based on Rivian's achieving gross profit milestones, $750 million equity investment in 2026 upon successful technology testing, and an additional $250 million in equity or convertible notes contingent upon further successful tests. A $1 billion loan facility scheduled for October of 2026, secured by Rivian's joint venture equity stake, an equity investment of $460 million in the second half of 2027, and by 2028, Volkswagen will fund 75% of development costs, easing Rivian's capital burden. Technological collaboration. So Rivian's zonal network architecture will serve as the foundation for development. The joint venture to create lower cost structures for mass market EVs expands consumer accessibility. Ownership of the software stack allows for rapid innovation and feature deployment. Operational structure. So the joint venture will be headquartered in Palo Alto, California. Management, there will be a co-CEO structure with leadership from both Rivian and Volkswagen, and the board will consist of 4 members, split evenly between Rivian and Volkswagen. Some key insights for investors. So this is significant validation for Rivian. Volkswagen's investment validates Rivian's technological leadership in EV software and hardware. The partnership positions Rivian as a key technology supplier in the global EV industry. Financial stability. The $5.8 billion deal provides Rivian with much-needed capital, ensuring operations through the launch of its R2 platform and manufacturing expansion. Shared development costs reduce Rivian's cash burn significantly through 2028. Global scale and affordability. The joint venture will enable Rivian's technologies to scale across multiple vehicle brands and global markets. Focus on lower-cost EV platform targets mass market adoption, a major growth opportunity. Long-term growth outlook. The partnership aligns Rivian for long-term cost savings and higher production efficiencies. Rivian remains fully independent in areas like propulsion systems and autonomy development. Risks. Rivian's ability to meet key milestones, such as profitability targets and testing performance, will determine the release of Volkswagen's incremental investments. So what's the takeaway? The partnership with Volkswagen is a landmark development for Rivian. It brings financial security, validates Rivian's technology leadership, and positions the company for significant scale and growth in the global EV market. However, meeting key milestones will be essential for Rivian to unlock the future potential of this deal. Now, the day after this transformational partnership announcement, Rivian CFO Claire McDonough presented at a Baird investor conference. Let's dive into the key takeaways. Volkswagen partnership as a game changer. So McDonough emphasized the $5.8 billion joint venture with Volkswagen as a transformational milestone for Rivian. It validates Rivian's technology leadership in electric vehicle software and zonal architecture. Rivian now has a stronger capital roadmap, enabling future product launches like the R2 and R3 platforms. Financial strength and cost efficiency. The Volkswagen deal reduces Rivian's cash burn. Volkswagen will fund 75% of shared development costs through 2028. She highlighted material cost reductions in Rivian's second-generation R1 vehicles, which improves gross margin. Rivian expects positive gross margin in Q4 2024, a significant step toward profitability. Production and supply chain updates. So McDonough acknowledged recent production disruptions due to supply chain issues. We mentioned earlier the Enduro motor components. Rivian remains committed to its 2024 production guidance of 47,000 to 49,000 vehicles. She emphasized Rivian's focus on operational efficiency and supply chain resilience moving forward. R2 platform and market expansion. The upcoming R2 platform is central to Rivian's growth strategy. 45% lower material costs compared to R1, targeting mass market affordability. Rivian's expanded manufacturing capacity in Georgia will support R2 production, positioning Rivian to scale globally. There's more to come on this next. Capital position and financial outlook. So Rivian's balance sheet is now significantly strengthened. Cash and liquidity are expected to fund operations through the R2 ramp and production expansion. The company reiterated its target for positive free cash flow by 2026. Long-term competitive advantage. McDonough emphasized Rivian's unique focus on vertical integration with software, hardware, network architecture, and premium yet rugged vehicles catering to adventures and businesses. The partnership with Volkswagen expands Rivian's technology reach to mass market EVs, creating new revenue opportunities. Some key takeaways for investors. The Volkswagen partnership provides Rivian with financial flexibility, validates its technology, and accelerates its global growth potential. Rivian is making tangible progress toward profitability and expects positive gross margin in Q4 2024. The R2 platform is a major catalyst for Rivian, addressing affordable EVs to reach a broader customer base. Rivian remains focused on improving cost efficiency, strengthening its supply chain, and achieving free cash flow by 2026. So this fireside chat reinforced confidence in Rivian's strategic execution and its ability to navigate challenges while scaling for long-term success. Now, if you can't take any more positive news, well, too bad. Rivian recently received a government loan of $6.6 billion.
Upwards of a $6.6 billion loan from the U.S. Department of Energy. Actually surprised to see shares lower because it looked like they were going to open higher, but have reversed course, adding to steep year-to-date losses, down more than 50% year-to-date, although it is up about 12.5%.
This funding is designated to support the construction of Rivian's new electric vehicle manufacturing facility in Georgia, which had previously been paused due to financial constraints. So key details of the loan and the project. project. So the purpose. The loan is intended to finance the development of Rivian's Georgia plant, where the company plans to produce its upcoming R2 and R3 models, which are smaller and more affordable EVs aimed at the mass market. Production capacity. The facility is projected to have an annual production capacity of up to 400,000 vehicles, with its first phase targeting 200,000 vehicles per year. Employment impact. The plan is expected to create approximately 7,500 jobs by the end of 2030, contributing significantly to the local economy. Timeline. Rivian aims to commence operations at the Georgia facility in 2028, aligning with its strategy to expand its product lineup and market reach. Strategic implications. Advancing U.S. EV manufacturing. This loan underscores the Biden administration's commitment to bolstering domestic EV production and supporting the goal of having zero-emission vehicles comprising half of all new U.S. sales by 2030. Rivian's growth and competitiveness. The funding enables Rivian to proceed with its expansion plans, enhancing its ability to compete in the evolving EV market by offering a broader range of vehicles at varying price points. Considerations. Conditional nature of the loan. So the DOE's commitment is conditional, meaning Rivian must meet specific technical, legal, and environmental requirements before the loan is finalized. Political context. The timing of the loan announcement comes as the current administration seeks to solidify its climate initiatives ahead of the upcoming presidential transition, which may bring changes to federal support for EV projects. So what's the takeaway? This substantial federal loan represents a pivotal development for Rivian, facilitating the advancement of its manufacturing capabilities and supporting the broader adoption of electric vehicles in the United States. Part 4, the moment we've all been waiting for, the valuation. 2021 was a big year for Rivian, with the company finally generating revenues and having a much anticipated IPO. But this also signifies a very limited track record. We've covered this in the past with other early stage growth companies like Rocket Lab, SoundHound, and SoFi. There is a massive amount of uncertainty in these models. Now, to combat this, I've done two things. Number one, I relied heavily on the insights of the 27 Wall Street analysts responsible for covering Rivian, especially when it came to revenue and capital expenditures. Number two, I treated Rivian as though it were Tesla over 5 years ago and scaled the expenses to reach Tesla's current cost structure by the end of the model. Balance sheet. Since the IPO in 2021, cash has seen a 3-year decline of 63%. Now, while this is a definite concern, the $5.8 billion Volkswagen partnership, coupled with the $1.3 billion of cash 2 weeks ago, gives Rivian much-needed breathing room. Rivian produced 1,000 vehicles in 2021, 24,000 in 2022, and close to 50,000 in 2023. Yet, they have maintained a steady property, plant, and equipment, which is quite impressive and shows that they are managing production capacity efficiently. While debt has more than tripled in the last 3 years, 73% of the debt is convertible with PIK or paid-in-kind interest, which adds to the balance and is not cash interest. Despite decreasing cash and increasing debt, the company has been net cash, which means cash is greater than debt, by over $2 billion through their entire existence as a publicly traded company. Retained earnings is an increasingly negative number due to negative net income. While net income does not turn positive in our model, it improves in 2028 and beyond. We're going to see this next in the income statement. So what's the takeaway? This is an early stage growth business with a conservative balance sheet and a promising future. Let's hop in the model. All right, balance sheet. So as we mentioned, we see a 63% 3-year decline in cash and cash equivalents. PP&E has remained flat, which shows production efficiency by the company. Debt has increased significantly, but as we can see down here, cash has been greater than debt by over $2 billion for the life of the company. Also, retained earnings is an increasingly negative number, and we don't see this changing in the future because they continue to generate negative net income. Income statement. Revenue has gone from $55 million in 2021 to $4.3 billion in 2024, a 78.4x increase over 3 years. While gross profit is negative, it has been improving each year since 2022, and management predicts it will turn positive in 4Q24. Now, while EBITDA is also negative, it has also been improving, eventually turning positive at the end of our model in 2029. Stock-based compensation is how many employees are paid when the company is in its early stages not making cash. This is common in early stage growth companies like Rivian, but like depreciation and amortization, it is non-cash, so it gets added back later on in the cash flow statement and the DCF. We're going to see this next in the cash flow statement. Because the company has been net cash, meaning cash is greater than debt, it is also net interest income, which means interest income is greater than interest expense, which means the interest generated from the invested cash is able to cover the cash interest expense and leave some money left over. Net income is negative throughout our model, which is the catalyst for our negative retained earnings. So what's the takeaway? While we do not see positive EBITDA or net income, for an early stage growth company, all metrics are showing improvement across the board throughout our model, which is a very positive sign. Let's hop in the model. The income statement, as we mentioned, massive increase in revenue, 78.4x over the last 3 years, early stage growth company, so we expect that. Gross profit, although negative, we see an improvement over the last 3 years. EBITDA does turn positive at the end of our model in 2029. I talked about stock-based compensation. We just have to be mindful with this because this is typically higher in an early stage growth company. It's how they typically pay their employees because they're thin on cash. Interest income outpaces interest expense. This is a tremendous positive. And as we mentioned, net income is negative throughout the duration of our model. Cash flow statement. While free cash flow is negative, we see the same improvement since 2022 that we saw with gross profit and EBITDA. And we even see positive operating cash flow at the end of our model in 2029. From the IPO in 2021 through 2024, the company has been very conservatively managing its capital expenditures, which has boosted the improvement in free cash flow. The company has issued $21.6 billion of equity versus $8 billion of debt. The good news is that both sources of funding have decreased since the IPO. The recently announced Volkswagen partnership and improving financials should hopefully accelerate the path for the company to be self-funded via cash flow. It is important to note that the cash burn rate is high, with Rivian projected to use $29.7 billion of cash over the next 5 years. Now, hopefully this will improve with the future $4.5 billion of funding from the Volkswagen partnership and an accelerated path towards profitability. So what's the takeaway? While we aren't surprised by the negative cash flows of an early stage growth company like Rivian, improving financial results since 2022, a newly announced partnership with Volkswagen, and increasing production and demand all mean a brighter future for the company. Let's hop in the model. So as we mentioned, free cash flow is negative, but it has been improving since 2022. We see that operating cash flow is negative, also improving since 2022. And we do see a light at the end of the tunnel. It's positive in 2029. Equity issuance, as we mentioned, was $21.6 billion over the life of the company compared to debt issuance of $8 billion. This is something to note that they have been decreasing the level of financing from both debt and equity since the IPO. Lastly, we see that the company has been using a tremendous amount of cash and will continue to do so through the duration of our model. Forecast drivers and DCF assumptions. So due to limited historical financials for the company, we cannot use these as a guide for our projections. Case in point, the 3-year average revenue growth is over 1,000%. As mentioned in the very beginning of the valuation section, I relied heavily on the insights of 27 Wall Street analysts responsible for covering Rivian, especially when it came to revenue and CapEx. I also treated Rivian as though it were Tesla over 5 years ago and scaled the expenses to reach Tesla's cost structure by the end of our model. In terms of revenue growth, the 5-year compound annual growth rates from Wall Street range from 31% to 38%, so I use that as our range. Now, while operating costs are 183% of revenues today, I did an annual step down of 5 to 10% so that operating expenditures would be like Tesla today by the end of our model. The company has a high beta of 2.25, which is very high risk, and this is expected as it's an early stage growth company. The company has no credit rating, and most of its debt is convertible. The cost of debt is 6.13%, and that's based on a weighted average as of 9/30/24. I had to do a pro forma for the shares due to the conversion of the $1 billion of debt held by Volkswagen, which was converted into shares on December 1st. This actually gives Volkswagen 8.6% ownership in the company. Also, I added the $1.3 billion cash infusion from Volkswagen to the 9/30 cash balance. This adds $1.16 of value to the stock. The terminal multiple of 3 times LTM revenue is slightly below the historical average for the company since 2023. We're going to see this next in the DCF valuation. So what's the takeaway? Conservative assumptions equals conservative results. Let's hop in the model. All right, a few key things to note here. We see that there's a massive amount of costs with the company prior to this year, currently at 183% of revenues. That being said, I have operating costs being down to 90% of revenues by the end of our model in 2029. A few other things to note here: revenue growth is based off of Wall Street consensus, 31 to 38%. Beta 2.25, no credit rating for the company, but weighted average cost of debt of 6.13. Now, as I mentioned, I had to do a pro forma or an adjustment to the shares based on the Volkswagen conversion of $1 billion of convertible debt, which occurred on December 1st. This gives them 8.6% ownership post-conversion. Also, in addition, because of this Volkswagen partnership, they contributed $1.3 billion of cash, which occurred at the end of November, but it's not reflected in the September 30th number. So I had to add that to the cash balance. Last but not least, let's check out the terminal revenue multiple. So the company is traded based on a TEV to LTM revenue range of 1.4 to 5.6 times since 2023. The average over that time frame is slightly over 3. The current multiple is 3.3. I went with 3 to be conservative. DCF valuation. We ran 3 scenarios, bear, base, and bull, with the current model at base. Future cash flows are discounted back to today to get to TEV. We strip out net debt to get to equity value. Rivian is trying to revolutionize the SUV and pickup truck demographic for electric vehicles. It has massive backing from Amazon and Volkswagen and is up over 40% the last month. While this has been an incredible run, it is still down over 82% from its IPO, but is it worth buying today? Wall Street has Rivian at an average of $15 per share, which is only a 2% discount. But what does our analysis show? Let's hop in the model. All right, y'all, DCF time. Woo woo. So we got EBITDA. We strip out DNA, stock-based comp. That gets us EBIT. We strip out the cash taxes, which they don't pay taxes. We get EBI or NOPAT. We add back the DNA and stock-based compensation. We take into account changes in operating working capital, and then we strip out CapEx. That gives us free cash flow to the firm. We have 3 times terminal revenue multiple, so we multiply that by the revenues in 2029. That gives us our cash flows to discount. We multiply that by the discount factors to get our present value of free cash flows. We add those together to get our total enterprise value. We strip out the debt. We add the cash. We strip out non-controlling interest. We add associate investments. We get an intrinsic equity value of $19.5 billion. Divided by the shares outstanding, that gives us an implied share price of almost $17.50 compared to the current share price of $14.70. That's a 19% discount and is a solid hold rating. Sensitivity and scenario analysis. We ran 50 different models by utilizing data tables. We sensitized revenue growth versus CapEx intensity and WACC versus the terminal multiple. 11 out of 50 or 22% showed a sell rating. 15 out of 50 or 30% showed a hold rating. 24 out of 50 or 48% showed a buy rating. We ran each of the 3 scenarios equally weighted, got a weighted average value of $17.70, which is a 20.4% discount. So utilizing conservative assumptions, we show a sell rating in the bear case, a hold rating in the base case, and a buy rating in the bull case. Let's hop in the model. All right, sensitivity analysis. We've got majority green, but red, yellow, green looks like the flags of Ghana or Cameroon. Makes me think of the World Cup. Ultimately, though, we see that there's a skew towards buy. Our rating is hold, but it's right on the cusp of buy. Last but not least, we come to our scenario analysis. We see about 1150 valuation and a sell rating in the bear case, about a 1750 valuation in the base case and a hold rating, but it's right on the cusp of buy. The bull case, $24 and change, 64% discount, a screaming buy rating. The weighted average value is $17.70, which shows a slight buy rating, though I want the stock to pull back a little more before I would be willing to buy. Wrap up. Wall Street has Rivian at a high of $23, which is a 56% discount, an average of $15, which is a 2% discount, and a low of $11, which is a 25% premium. Now, you should seek the advice of an investment professional always. I do not know your individual financial situation, and this content is meant to educate and is not investment advice. That being said, I personally do not have a position in Rivian, and I think it's gotten a little ahead of itself since its big 40% run over the last month. In the low $14 range, the stock becomes very enticing, and I think it will pop once they achieve positive gross margin, which is projected in 4Q24. Since its IPO in November of 2021, the stock is down over 82%, and it's down over 30% year to date, so there will probably be tax loss selling in the next couple of weeks. Amazon owns over 15% of Rivian, and Volkswagen owns over 8%, and it's going to increase with their partnership moving forward. While I see the long-term potential of electric vehicles, outside of Tesla, I have not been enticed by any of the other options out there, but I think Rivian is the positive EV outlier. The financials are improving, production is increasing, and having the backing of both Amazon and Volkswagen makes me a believer in the future potential for Rivian. They are growing slowly and methodically and are not making the mistakes of too much debt or building out capacity before demand justifies it. The recent $6.6 billion loan from the Department of Energy for the Georgia production facility is a huge positive since this has been mothballed since 2021. Now, expect volatility in the stock with a beta of over 2, but that will provide the opportunity to invest on pullbacks, and the stock is at a very reasonable revenue multiple, especially considering the company's future trajectory. If you missed out on Tesla, I would seriously consider Rivian as an investment option in the EV space.
The future is now.
If you like this and want to see another in-depth stock valuation, check out my Coinbase model here or my Intel model here. And if you found this valuable, please share this with someone who you think would enjoy this. And as always, be relentless.